Good afternoon, everybody, and welcome to this week's education session for the Elite Traders Club, November the 25th, 2015, and this week's topic is that of soft stops. Let's get underway. The disclaimer first and foremost: the content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether that advice is appropriate in light of your financial circumstances. Topics for today: soft stops is the major heading, the major theme. We're going to have a look at the setting of the initial protective stops, how we go about that, the trailing of those stops, and also the ways that we can exit. So very important, whether we exit after we've been in a trade for a substantial period of time, and that is exiting through the use of a trailing stop, or whether in the odd scenario where a trade goes against us from day one and hits our initial protective stop. What are the rules for getting out once that occurs? So let's go through and clarify that. The initial setting of our protective stops is all based on volatility, and the way that we measure volatility is through that of average true range. Average true range just measures the daily upward and downward movement of a security, and it also includes gaps as well as the entire trading range for that particular day. So what we do is we pick a look back period. Now for the majority of cases it's either 14 or 21. Now for ETC we use a look back period of 21. So we're calculating what the average movement is, either up or down, over the last 21 periods. So we're getting an average, if you like, of how much that stock likes to move up and down. Now obviously in terms of setting our protective stops, we want to make sure that where we're positioning that protective stop, that we're not too close to the price action. Now if we go and put our protective stop just on the average true range, that's just one single average true range, then we're really asking to be stopped out, because that level is just an average and the stock can actually move more or less than that amount. So we always set our protective stop losses a minimum of 2 times that average true range away. Now you can go as far as 4 ATR or 5 if you want to. The only issue that you have with that, even saying or acknowledging that wider stops are much better than closer stops, is that you're really then asking the stock to do a lot of work to get to your predefined objective, your predefined target. So somewhere generally between 2 and 3 is a fair and reasonable distance away from your entry level. The other aspect, purely from a technical point of view, other than considering the volatility, is that we always want to hide those protective stops below the most recent medium-term trough. Now remember, each medium-term trough as it forms is telling us that where the location is of the most current point of demand. Each one of those medium-term troughs representing a point of demand. Now obviously the theory is here that once a point of demand is established, it is very likely to act as a point of demand in the future. So should prices start to move back down after triggering, then it's more than likely that that old point of demand is going to re-enter the market, if not at the same level, certainly at a higher level, given that the market is still in favour of this stock. So it makes sense to use those obvious points of demand that we can locate on a chart to hide or position our protective stop below those as well. So when we're looking to establish our initial protective stops, we need to first of all make sure that we're taking into account the volatility. That is, we need to have our protective stops at least 2 ATRs away from our entry, and we also need to make sure that that protective stop is a minimum of 0.5% below the most recent medium-term trough. So having established our initial levels for our stop losses, we then need to have a bit of a look at what actions we need to take should those stop losses be broken. So When we're setting our initial 2 ATR base stop, the reason that we use a 2 ATR base stop as opposed to a 3 is that using a 2 ATR base stop, it just gives us more bang for that fixed level of risk, if you like. So we're really looking for the optimal position size. Now, obviously, not all trades are going to move in the right direction from once they're triggered. Occasionally, we will get trades that trigger, turn around, and go completely the opposite direction. That's just the market at work, and it's going to happen on the odd occasion. And so what we need to have is obviously a clear set of rules that tells us exactly what to do, but also allows the trade as much opportunity to prove itself. So when we're setting our initial 2 ATR base stop, should the price move against us and close below that initial 2 ATR base stop, then that's the signal for us to exit at the market open of the next period. Whether that happens to be next Monday morning if it's a weekly chart, or it could be the next morning if it's a daily chart. All right, so there should be no black and white, no grey about that. It should be purely black and white. If price closes below that initial 2 ATR base stop, then we need to exit the following period. And I'll explain why that's a preferred method of exiting should price turn around from the open and kick us out of the trade in a relatively short space of time. Now, the other method of exiting is once a trade has started to move in the right direction, then what will naturally occur is that the trailing 3 ATR base stop, now remember we use that trailing 3 ATR to give the stock lots of wiggle room, lots of room to move, so that it has every possible chance of moving in the right direction, but also allowing for inevitable pullbacks in the market, because again, we're really looking at being in these trades for as long as possible whilst that trend continues to move to the upward side. Now, this is a method that the turtle traders use with a huge amount of success. It was very, very simple, but it's also a very, very important concept, because whilst we're very much used to letting, to cutting our losses very short, and that's one aspect of trading that a lot of people struggle to begin with, is cutting their losses short. Once they've got that under control, the next major obstacle is letting their profits run. So you can't cut your losses short and cut your profits short as well. It just won't work, and you won't be profitable over the longer term. Okay, so very important to remember that and to focus on trade management when you're in the trade, and being patient and allowing that wider trailing stop to do exactly what it needs to do, and that is to keep you in the trade for as long as possible, to ride that trend for as far as you can. Now, having said that, once the trade moves in the right direction for a period of time and that trailing 3 ATR is serving its purpose, then at some point in time, price is going to come back towards that trailing 3 ATR. Now, it's exactly the same rule as for our initial 2 ATR base stop, and that is once price closes below that trailing 3 ATR, then we must exit the next period, whether that's the next day if you're on a daily periodicity, or the very beginning of the next period. That is, if it's a week, so that would mean on the Monday morning following the close below that 3 ATR based protective stop. So let's go through and have a look at an example of this just to illustrate. So here we've got a stock, ULTA, in the States. Now, this was a setup quite a long time ago where we had this formation of this new higher trough. So it satisfied all our price action filters, good relative strength, blue sky, all those sorts of things. Now, the initial protective stop, as you can see, this red line, was well below the most recent medium-term trough and outside of 2 ATRs. Now, that's ideally a good spot to have our protective stop, in that it's hiding below that last point of demand, and it's also taking into account volatility. Now, no sooner were we triggered in on this particular trade and we had a black candle. So price moved up and then closed down towards its low the following week. So not a particularly good start to this particular trade. Now at this time, you might remember at the end of August, there was extreme volatility in the market. And during the following week, mid-session, the Dow was down 1,000 points. Mid-session, it did come back. But subsequently, during the course of that particular week, this stock breached its initial 2 ATR based protective stop. It went all the way down to around about $119.57 before gathering a whole lot of demand, and that was what pushed it all the way back up much, much higher. Now, the actual close of that particular candle was at $159. Now, you'll see over to the right that our initial 2 ATR based stop is $158.70. So it actually closed above our initial 2 ATR based stop. So according to our rules, that would mean that we are still in the trade. Now, the old rule, the old way of handling this was that if the price action came down and breached the protective stop, that we would then need to convert that soft stop into a hard stop. So that meant putting a hard stop 0.5% below the low of the candle that breached the initial soft stop. Now that would mean now putting in a hard stop all the way down at $119.57. Well, it should be fairly obvious that the initial risk that we wanted to take on was the difference between $171.23 and $158.70. So there we're looking at around about $13 of initial risk on a $170 stock. So in percentage terms, that's not a great deal. It's probably around about 7 or 8%. However, now that we had to convert that initial soft stop into a hard stop, we're going to end up with nearly 3 times that amount of risk on the trade. Now, the way I think about it, that's just silly. Certainly, there's the odd chance that this type of move can happen to any particular stock, and it's going to happen every now and then. But most often, we're not going to get these sorts of moves on a regular basis. And having and the use of soft stops over the longer term, I think you'll find is going to be more beneficial than using hard stops. So, if we take the rule that when price closes below that initial 2 ATR based stop, then we've got to keep waiting. In actual fact, the following week there was a little candle here, and you'll see that if I put the cursor over there, the close of that particular candle is at $157.70. Now that's below the initial $158.70. It's $1 below. So at that point there, that would be an exit out of ULTA. So it would be exiting that at market at the very next open. Okay, so that's the candle that formed late on Friday at the close of the market. So we wait for the market to open on a Monday and we exit at that particular time. Okay, so that should make it very clear that once price has closed below the initial 2 ATR based stop, we simply exit. We don't worry about converting a soft stop into a hard stop. We just simply exit. And it's exactly the same rule when we're in a profitable trade, that once price closes below our trailing 3 ATR, that's the green line, then we exit that trade as well. So hopefully that's helped to clear things up. If you've got any questions in relation to that, certainly please feel free to get in contact with us. If you do need any assistance in terms of putting your trailing stops on beyond charts, again, please request a coaching call and we'll point you in the right direction for that. But certainly, trailing stops are really, really important. They do help you to let your profits run, and using that ATR based stop, because again, it's a volatility based stop. So it's not price action driven, it's volatility driven, which is very important because stocks are going to go through periods of low volatility and high volatility, and having a trailing stop that takes that into consideration is extremely helpful. Well, that's it for this week. Thank you for watching, and I look forward to catching up with you again soon. Bye for now.